let's talk more in depth about the statement of cash flows. The statement of cash flows reports the impact of a firm's operating, investing, and financing activities on cash flows during the accounting period. In fact, some would say that users of financial statements have made the statement of cash flows one of the most important of the 4 required financial statements. One of the most important resources of any company is cash. If a company cannot generate sufficient cash, its ability to continue operations is significantly limited. The statement of cash flows is a financial statement that summarizes a company's inflows and outflows of cash over a period of time. Its purpose is to inform users on how and why a company's cash changed during the period. So that is as informative as possible. The statement groups and reports cash flows in 3 major categories: operating, investing, and financing. So this net change reconciles the difference between the beginning and ending cash and cash equivalent balances from the balance sheet. So the change in cash that we see on the statement of cash flows has to tie in to ending cash on the balance sheet. So that means the purpose of the statement of cash flows includes these 4 items. 1, providing information about cash inflows and cash outflows during a period. 2, providing information about cash changes between 2 balance sheet dates. 3, disclosing items that affect the balance sheet but don't show up in the income statement. And finally, categorizing changes as one of those 3 categories: operating, investing, or financing activities. So the 3 groupings of cash flows are presented in the basic structure of the statement that you see here. So first, we have cash flows provided or used by operating activities, and those are the cash inflows and outflows arising from the company's operations. So these inflows and outflows are sometimes called operating cash flows, and they would include things like cash inflows from sales or services and cash outflows for operating items such as inventory purchases, salaries, insurance, and supplies. And then the second section is cash flows provided or used by investing activities. And so those are cash inflows and outflows arising from the acquisition and disposal of non-current assets. So these are often called investing cash flows and would include things like inflows from the sale of property, facilities, equipment, or investments, and outflows from the purchase of property, facilities, equipment, or investments. And then our last section is cash flows provided or used by financing activities. And those are the cash inflows and outflows associated with the generation and return of capital to investors. So these are often called financing cash flows, and they would include things like cash inflows from borrowing or issuing stock, cash outflows to satisfy debt obligations or to repurchase treasury stock, or cash outflows for dividends to stockholders. So take a look at this statement of cash flows example. This is an example of Under Armour's condensed statement of cash flows. And it shows that operating cash flows are presented first in the statement of cash flows. Essentially, operating cash flow is generated as a result of cash inflows and outflows associated with selling goods and providing services. Investing cash flows are listed second, and these cash flows result from the acquisition of non-current assets that we just talked about, like property, plant, and equipment. And then finally, you see in this example the financing cash flows, and those result from transactions related to borrowing or issuing stock. publicly traded companies prepare the statement of cash flows using a format similar to what we've described. In some cases, companies must also make one or both of the following two disclosures: significant non-cash investing or financing activities and cash paid for interest and taxes. So this slide presents disclosures for non-cash investing and financing activities. Even though these transactions do not involve cash, they are important for properly understanding a company's cash flows. Therefore, they must be disclosed either on the face of the statement or in the notes to the financial statements. So these are the disclosures that Under Armour makes on its statement of cash flows. And this slide presents an example of Under Armour's additional disclosure for cash paid for interest and taxes. Recall that the income statement, the statement of retained earnings, and the balance sheet are prepared with numbers from an adjusted trial balance. However, the statement of cash flows is different. It's prepared with information collected from a variety of sources, including the examination of the changes in all non-cash accounts. Therefore, in order to explain a company's change in cash, you must explain the changes in the company's non-cash accounts. And to do that, you need these three items: the comparative balance sheet, an income statement, and then additional information on changes in account balances. So to understand why, let's first consider the fundamental accounting equation. As shown in the top box of this slide, cash can be isolated by breaking it out from other assets, yielding cash plus non-cash assets is equal to liabilities plus equity. Moving non-cash assets from the left side of the equation to the right side yields cash is equal to liabilities plus equity plus non-cash assets. This equation can be rewritten to show that the change in cash for a given period is equal to the changes in all other non-cash accounts. And sometimes that's referred to as the cash change equation that you see in the bottom box. So as noted earlier, when preparing the statement of cash flows, all companies report cash flows from operating, investing, and financing activities. And we've already talked about the types of activities that fall into each area. The manner in which cash flows from investing and financing activities are reported is the same for all companies. However, companies can report their cash flows from operating activities using one of two methods, either the direct method or the indirect method. Using the direct method, a company reports its cash inflows from operation followed by its cash outflows or disbursements for operations. Under the indirect method, a company reports its cash flows from operating activities by adjusting its net income from an accrual basis to a cash basis. So both methods will yield the same net cash flows from operating activities, and a company is free to use either the direct or the indirect method in its statement of cash flows. However, accounting standards require that if a company uses the direct method in its statement, it must disclose the indirect method as well. So as a result, most companies just use the indirect method. Regardless of whether you use the direct or indirect method to prepare the statement of cash flows, the investing and financial activities sections are calculated the same way for both methods. Only the operating section differs in its approach to determine cash flow. However, it's important to remember that both methods will agree on the total change in cash.